Good afternoon, everyone. In this video, I'm going to have a look at and work through examples or transactions covering depreciation methods, the straight line and the reducing book value method, diminishing balance method. Going to calculate current depreciation, accumulated depreciation, and the book value in these transactions. So what you can do is you look at one example, master it. You can move forwards and backwards in the video. So if you're happy with the simple ones, you can move forward in the video and have a look at some of the difficult ones. But you can always watch them over and over again until you master them. In this first example, I'm going to look at an example where a vehicle is depreciated on the straight line method, also known as the fixed installment method. So we're looking at straight line depreciation. So vehicles with a cost price of 250,500 Rand were purchased on the 31st of October 2015. The current financial year ends the 31st of December 2015. The company depreciates vehicles at 25% per annum using the straight line method. Calculate the depreciation for the current financial year. So the nice thing here is this vehicle was bought in October 2015 and the year end is the 31st of December 2015, and we're using the straight line or fixed installment method to depreciate the vehicle. It's quite easy. Remember, depreciation is wear and tear on a non-current asset. This vehicle cost 250,500 Rand. They tell us that the depreciation is 25% per annum. And if you go and see from October 31st, the 31st of October, so it's the end of October 2015, to our financial year end, the 31st of December, it is 2 months. So 250,500, the cost price, multiplied by 25%, they tell us it's 25% per annum, and that is equal to 10,437 Rand and 50 cents. But remember, it's only for 2 months, so multiplied by 2 over 12. And if we did round that off, you might have to round it off to the nearest Rand. That would become 10,438. 50 and above, it would be rounded up to 8. If it was 49 and lower, it would stay 7. So that's the first example here. What we did was we used the straight line method of depreciation to depreciate a vehicle that was bought. We had the vehicle for 2 months, and there's the calculation. Easy. Right, next example. Land and buildings depreciate using the straight line or fixed installment method depreciation. So land and buildings with a cost price of 870,000 was purchased on the 1st of February 2019. The current financial year ends 31 December 2019. So these land and buildings were bought in the current year. Remember, a financial year is the current 12 months that we are reporting on. any 12 months, consecutive months, which are current. That is your financial year. So the company uses a depreciation rate of 5% using the straight line method. Buildings cost 694,000. Now when we do land and buildings depreciate. The land is not depreciated. So the depreciation of 5% in this example is going to be on the 694,000. Then we need to calculate for how long we have had this building, and is it in our current financial year. We need to calculate, according to the question here, the current depreciation. So only the year that we're looking at the moment. So what we need to do is we need to take the building value. They gave us that 870, maybe just to trick you, because that was both land and buildings, but we only want the building value multiplied by 5%, and from the 1st of February to the 31st of December it is 11 months, so it's multiplied by 11 over 12, and that gives 31,808 Rand. So the current depreciation is 31,808 because we only had this building for 11 months. Right, capitalization of property, plant and equipment costs. What capitalization means is costs are added to the value of the asset. The costs are not expensed, they're added to the value of the assets. So certain costs relating to non-current assets, PPE, can be capitalized. So let's look here. Calculate the total cost that will be capitalized for the laptops. So if we look at the information that has been given to us, we got 2 laptops. That fits the definition of a non-current asset. Here they're saying that in this example, the software is specialized. It's 5,000 Rand per laptop. So the software is loaded onto the laptops and it's adding value to the laptops. So that is going to be capitalized. Delivery charges, we know. If PPE is delivered, non-current asset is delivered to the premises, that delivery cost will get added to the cost of the asset. Just one thing, when you're doing a question like that, just check the numbers. There are 2 laptops, 42,000 each. There's 2 laptops that got software, 5,000 Rand each. And there's a delivery charge. These training costs, insurance and maintenance are all expenses and are not treated as assets. That don't add value to the PPE, but the first 3 here do. So let's check what is the cost price of these laptops. And in order to calculate it, there were 2 laptops. They both got software and the laptops were delivered. So there's the 2 times by 42,000 from the information that was given to us. Software on both laptops and the delivery. So the cost of the laptops was 96,000, not just 84,000, because software was added and the laptops were delivered. So the cost price, like I said, of the laptops to us is 96,000. Right, next one, calculating current depreciation using the straight line method. That's the type of example I'm going to look at. So we got these laptops again. Let's check what the depreciation is, and we're using the straight line method. So it says calculate the total depreciation for the current financial year ending 31 December 2023 for the laptops. The depreciation policy is 30% on the straight line method. Assume the laptops were only ready from the 31st of March. That is important, because when an asset becomes useful or starts being used, you can depreciate from that date, even if these laptops were bought before the 5th of March. They say we're only starting to use the laptops on the 31st of March. Now, in order to calculate the depreciation, we need the cost price, because depreciation is the cost price times by the percentage. And here, the cost price we did calculate in the previous example, but let me just refresh your memory. The cost price of the two laptops was 2 times by 42,000 plus the software plus the delivery. The cost price of the laptops is 96,000. The year end is the 31st of December. We've used these laptops from the 31st of March. Now you need to depreciate for the current financial year. And the current depreciation is 96,000. They said the laptops, if I didn't mention it before, they're being depreciated at 30% per annum. And from the end of March to the end of December, it's 9 months, so multiplied by 9 over 12 is equal to 21,600. So that is the current depreciation of the laptops, the wear and tear on the laptops, 21,600. We've had the laptops, been using the laptops for 9 months. So that's an example on calculating the current depreciation using the straight line method. Now, calculating current depreciation using the straight line method again, excluding land in the calculation. So here we're going to do depreciation for land and buildings, but when we do depreciation for land and buildings, we need to exclude the land amounts because the buildings are depreciated. So let's have a look at this one. Now, before I carry on, we first have to look at all the information with regard to land and buildings so we see what's happening. On the 30th of June, it says date purchased. There were buildings of 785,000. Now remember, in this example here, there's land that was purchased on the 1st of January 2017, 50,000 Rand. But remember, when we do the depreciation, we leave out the land. Now assume that buildings were made on the land 30th of June 2018, built, and the building was 785,000. That must get depreciated from building number 1, the 30th of June 2018. Then on the 1st of June 2020, there was land and buildings 800,000, but of the 800,000, 70,000 was land. So here we go. 1st of June 2020, building number 2 was purchased and the building is 730,000, because 800,000 minus the land 70,000 is equal to 730,000. This is a tough one, but if you need to work through it again, you do it 3 or 4 times until you've got it, because it'll stand you in good stead for the other ones that are coming up. So I'm going to run through this again. They're saying we must calculate the depreciation at the end of 2020. The 30th of September 2020 is our year end. This first building we purchased on the 30th of June 2018. The first financial year end is the 30th of September 2018. So this building we had for a few months. Then we had it in another year until the 30th of September 2019. That's building 1. Then we had it for another year until year end 30th of September 2020 is where we're at. And this other building, 730,000, we purchased actually in our current year, and we've had it from the 1st of June until the 30th of September. And from the 1st of June to the 30th of September will be June, July, August, September. 4 months. So lots of information here. But hopefully this explanation just makes it a little bit clearer as to what's happening with regard to land and buildings. So this table here tells us about the land and buildings. Now they say the depreciation on land and buildings, actually just on buildings, is 5% on the straight line method. Then they say calculate the current depreciation. So we want the depreciation for the current year ending 30th September 2020. So when we break it down, we've had building 1, the 785,000 in the current year for a full year. It was for a full year. That building, 785,000, in the current year we still have it, is 785,000 times by 5%. That is the first building that we purchased. We've had it for this full year. Plus, we want the current depreciation of building 1 and building 2. Now, building 2, remember, we have to take off the land portion. And building 2 was purchased on the 1st of June. And from the 1st of June to the 30th of September is 4 months. So land and buildings, there it says there, is 800,000. But we must take off the 70,000. Then we multiply by 5%, and we've had it for 4 months, the new building. So the current depreciation for building number 2, the new building, is 12,166.67. So I've got the current depreciation for building 1 and building 2, and I need to add those two together. And if I add those two together, the current depreciation is 51,416.67, and if I round that off, it's 51,417. Remember, when you're rounding off, round off to the nearest rand. If ever you get an answer in a test and you 1 rand out, pick that answer where you 1 rand out. So that question there was current depreciation for land and buildings on the straight line method. Listen to it again if you have a problem with it. Right, calculating the book value of land and buildings. Okay, this is coming from the same information as what we just dealt with. We want the book value of land and buildings. It says calculate the book value of land and buildings at this date, 30th of September 2020. Now you must know book value is equal to the cost price less the accumulated depreciation right from when you had building 1, when you first purchased building 1. Accumulated depreciation is all the year's depreciations added up. Now the cost price in this example here was 50,000. Now listen very carefully to this. When you calculate the book value for land and buildings, you include land, not just the buildings amount, because we want the book value for land and buildings. So the cost price will include the land amounts. When you calculate depreciation, you exclude the land amounts. But what we're calculating here is the book value. So the cost price of land and buildings was the land purchased for 50,000. There it is. Then you got 785,000 the building. Then there was 800,000, which already includes that 70,000. So if we add that up, there we go. The cost price for land and buildings is 1,635,000 in purple. So I'm going to say again, when we're calculating the book value, you include the land amounts and the building amounts. Now what we need to do is we need to calculate the accumulated depreciation on the land and buildings. So as we've discussed previously, building 1 in this first year, we had it for 3 months, and the building portion, now I'm only looking at the building portion, 785,000 times by 5% times by 3/12. I'm busy calculating the accumulated depreciation on the buildings. We've got the cost price, it's 1,635,000. Building 1, year 1, we have got now 9,812 Rand and 50 cents depreciation. Building 1, year 2, it's on the straight line method. 785,000 times by 5% is equal to 39,250. That's year 1, year 2. Building 1, year 3 was for a full year, because that's our year 3. There's year 1, year 2, year 3. So building 1, year 3 depreciation is 785,000 times by 5% is 39,250. So that is the accumulated depreciation for building 1. But there was another building bought. And building 2, remember, 730,000, we took off the land amount, multiplied by 5%. They said land and buildings depreciated 5% per annum on the straight line method. We've had it for 4 months, and that is the amount. So now the accumulated depreciation, we need to add up all the depreciation amounts to see what it is. Just cleaning up a bit here, make it a little bit neater, because this one sets us up for the rest of the video. Cost price minus the accumulated depreciation. And the accumulated depreciation, if I add them all up, 981,250, 39,250, 39,250. That's building 1, and that's building 2. Comes to 100,479. How do we calculate book value? Cost price less accumulated depreciation. So we've got the cost price and we've got the accumulated depreciation. And there it is, the cost price of the building. Very important. You must include the land amounts. The depreciation is only calculated on the buildings. And what is the book value? 1534521. If you have to, you go through that again. Because if you go through this one, the others get easier. This one was a little bit tough. Book value is equal to cost price less accumulated depreciation. In the cost price, you must include the land and the buildings amount. The depreciation is only on the buildings. And the book value of land and buildings at the end of this current year is 1534521. Next one. Now it's actually quite easy. Calculate the accumulated depreciation for land and buildings. When we calculated the book value in the previous one, we had to calculate the accumulated depreciation. Let's have a look. Our year end is the 30th of September. There once again is all the information with regard to land and buildings. We had building 1 and building 2. Building 1, year 1. Building 1 up until year 1, we had it for 3 months. It was 785,000. There it is. Times by 5%, times by 3 over 12, 981,250. Then we had building 1 for a full year until there. Year 2, 785,000 times by 5% equals 39,250. Year 3, full year. So that's building 1, the accumulated depreciation for building 1, but they want all buildings, land and buildings. And then we got another building, building 2, 730,000 times by 5%. We only had it for 4 months, times by 4 over 12. And what is the accumulated depreciation? You add these together, 9812, 39,250, 39,250, plus the 12,166.67, and the accumulated depreciation is equal to those 4 calculations add up, 100,479. But we did that in the last example as well, because we calculated the book value. If this one is a little bit complicated, you go back in the video and you watch it again. And hopefully you will have a smile on your face once you've been through this a few times. So I hope this video was useful. If it was, give me a thumbs up. Anyway, have a good weekend. Cheers.